So what am I doing?
Am I talking to the camera or are you talking to Brian?
We just want a perfect, that's all.
Are we doing bonds or are we doing the third one?
Looking at him?
Are you kidding? I said if I could jump through the phone
what I say
and kiss you right now, I would.
You're watching Paragon TV.
Welcome back to Paragon TV. I'm Ryan Garrett. I'm here with Dave Young and Nathan White of Paragon Wealth. And today we're going to talk about bonds. There's always a lot of talk, safety and otherwise, that are associated with bonds. What are your thoughts today?
Yeah, Ryan, bonds are really interesting right now because, like you say, a lot of investors for years and years have gone to bonds for safety. Mm-hmm. And the situation we're seeing right now is there's actually a lot of risk in bonds. And so our position for the last several months has been that we've been recommending to stay away from long-term bonds, some intermediate-term bonds, and then mainly hold short-term bonds and high-yield bonds.
When you say short-term, what do you mean as far as?
Short-term, 3 years and less.
Okay.
So that's kind of been our position up to now, and we still generally have that position, but there have been some dynamics that have changed, and just recently with some Fed actions and that are affecting the bond markets and making it a little less scary than it was a month or two ago.
Like the Fed announced the quantitative easing part 2, and as soon as they announced that, which they're going to basically buy treasury bonds, and they started that the first part of November, but ironically enough, the Fed, which basically unlimited checkbook, comes in to buy bonds, and what happens to interest rates? They go up. So bonds have been selling off since then. Partly, different factors. A lot of people will argue different things about it, but as Dave said, we were very cautious on a lot of bonds there at the end of the summer, first part of the fall, because we saw bonds kind of getting toppy, and there just wasn't enough return for the risk you were taking. Well, now short-term bonds have really sold off. The 10-year note has gone from 2.5 up to about 3.25. 75 basis points doesn't sound like much, but that can be a lot, especially if you're holding it. You might have just lost 6% if you just bought the bonds there at the tail end of the summer. Which we were advising people to avoid. Now, though, with interest rates kind of popping back up, we can selectively maybe get in, and maybe there's some trading plays, things like that we take a look at, certain areas, sectors in the bond market that might be okay, because in the end, we don't know how, the Fed has just started quantitative easing, and they could come in at any time and say, well, we've had enough of the rates starting to move up, and then really, kind of putting their foot down on the pedal. So we'll have to wait and see. But the situation's definitely changed here over the last just month that fast.
The bottom line is bonds used to be a place to go for safety, and you can't just go there and be safe right now. Yeah. So what we're saying is, yes, you can venture into certain bonds in certain areas and add value to your portfolio, but you can't just do it blindly like you used to be able to. You used to be able to just show up. Right now, the risk to reward on a lot of bond trades is just not there.
Right. See. So we might want safety in bonds, but like Dave said, you got to pick which areas you want, right? Because if the bull market in bonds is ending, and now we could face flat rates to rates increasing over the next who knows how long. How are you going to invest in bonds? Mm-hmm. I think you need a more tactical portfolio in bonds. You got to watch what you're doing because the tide is moving against you. The current is moving against you, and so how it's not like Dave said. Past 30 years, you just invested in bonds and you got a good return just by holding it. Well, now it might be the reverse. So it's not to say don't invest in bonds per se. You just got to watch what you're doing with them.
Certainly not the safe play 100% like people thought in the past.
No,
yeah, right.
And the thing that's extending it right now is quantitative easing. The fact that the Fed's injecting $600 billion into the markets with quantitative easing has created a situation where we don't know how long it will be before interest rates start to go up. I mean, before we felt like that was near on the horizon. Yeah. Right now, it might be in 3 months, it might be in 6 months, it might be in a year. We don't really know, but it's something we've got to be on high alert to watch out for as those rates coming up.
Great. Well, Dave and Nathan, I'm glad you guys could stop in. This is Ryan Garrett. Thank you for watching Paragon TV.
You're watching Paragon TV.